Governance and Ethics Board, Sharia scholars and Islamic banking experts, chairman and members of Sharia boards of several Islamic banks to give us the opening remarks. Dr. Ghassim, the floor is yours.
السلام عليكم ورحمة الله وبركاته. بسم الله الرحمن الرحيم. الحمد لله رب العالمين والصلاة والسلام على سيد المرسلين وعلى آله وصحبه أجمعين. Dear participants, at the outset, I would like to highlight that salam is a contract permissible in Sharia and acceptable to all fiqh schools. Its legitimacy is derived from the Holy Quran, the Sunnah, and Ijma. When the Prophet, peace be upon him, arrived in Medina, he observed that people were selling dates for deferred delivery after 1 or 2 years on salam basis. He advised them that payments for dates on deferred delivery should be based on specific weight and measure. So as long as the weight, the measurement is known, specified in the contract, and the delivery date is known, the amount of the capital or the purchase price of salam is paid upfront, it is a fully Sharia compliant contract. So there is an ijma or consensus on permissibility of salam. Similarly, the legitimacy of istisna is rooted in the Prophet, peace be upon him, own request for the manufacture of a pulpit by a carpenter and a finger ring, as well as the practice of the salaf, which is called ta'amul salaf. And by salaf, we mean the companions, yani sahaba, wattabi'un, ridwanullahi alayhim ajma'in. The beauty of Sharia lies in offering tailor-made solutions for every segment of the real economy. And this is contrary to the conventional financing, which uses interest-based debt instruments for every situation. IUFI has allowed both contracts and issued separate Sharia standards for salam as well as istisna. Globally, Islamic financial institutions use these contracts to meet financial needs of their customers. This shows that the principles and contracts of Sharia are practical and applicable in today's different business environments and legal jurisdictions, aligning with contemporary requirements. Although istisna was initially allowed by Ahnaf only, but today effectively it is used by the followers of all fiqhi schools, al-Malikiyya, al-Shafi'iyya, al-Hanabila. The role of Dubai Islamic Bank in developing istisna and other innovative structures. Dubai Islamic Bank is the leading Islamic bank and a role model, is a pioneer in innovation. And it has been effectively using both salam and istisna contracts for many years. For example, the DIB covered card is structured based on salam contract. Similarly, DIB uses istisna for retail financing, such as home financing, as well as for corporate and business banking needs for construction purposes and financing even big projects. Istisna not only helps us to provide financing in advance, but it also ensures that the funds are used appropriately. Disbursements are linked to specific milestones during construction and manufacturing, helping prevent misuse and ensuring compliance with Sharia principles. In UAE's context, the licensed institutions under the Central Bank of UAE currently follow international financial reporting standards for their financial reporting. And as such, they are not following IUFI accounting standards. And therefore, presently they will not be affected adversely or in any way by adoption of these standards. Undoubtedly, the practitioners, Islamic bankers, and Sharia scholars, they all agree that financial reporting and accounting is an essential part of proper Islamic banking. The main goal of financial reporting is to provide useful and reliable information for all the stakeholders. Your books should capture the real essence of your contracts. Islamic financial transactions such as mudaraba, musharaka, ijara, salam, and istisna are undoubtedly different in nature from conventional banking instruments. Current IFRS standards or any other framework may not fully capture their true nature. Therefore, this matter requires the utmost attention from regulators and Sharia scholars, committees, and boards, especially the standard setting bodies. It is essential that Sharia compliance should not be limited to structuring and documentation alone. Rather, it should be extended to accounting practices and financial reporting as well, ensuring that Islamic financial transactions are accurately and transparently reflected in the financial statements and books of the Islamic financial institutions. Financial reporting is not merely about recording executed transactions, as it has serious Sharia implications and significant impact on profit recognition. IFRS and IUFI have different approaches to profit recognition, which directly impact profit sharing and distribution to depositors of Islamic banks. In this regard, I really commend the efforts made by IUFI, which is actively working on developing new standards, not just issuing new ones, but also continuously updating and reviewing the existing standards and proposing amendments to better align with the industry needs and contemporary trends, demonstrating IUFI's commitment to ensuring that Islamic financial reporting remains relevant, effective, and also captures the real nature of the underlying contracts. However, let me point out that there are certain practical challenges faced by Islamic banks when they wish to implement IUFI accounting standards, which require further discussion and resolution by IUFI itself and by central banks and all those who are involved. For instance, under IFRS, banks typically recognize revenue and accrue income from the first day of transaction or disbursement, definitely following the conventional methodology, adopting a more immediate recognition approach. In contrast, IUFI standards generally require that revenue can only be recognized upon the transfer of control of the inventory from the seller to the buyer, or to the, in this case, the Islamic financial institution. This means that until a salam or istisna asset has not been delivered to the institution and subsequently sold to the customer or leased to the customer, the banks under IUFI accounting standards cannot recognize revenue in their financial statements. And this can create a large gap in their revenues. So definitely this needs further scholarly discussion, not only on the accounting side, but also in developing new structures by the Sharia committees, Sharia scholar communities to cater for these needs. And then there are some specific comments from our team at the Islamic Bank, which may be shared later by Brother Mian Nazir or maybe myself during our discussion. I don't want to to speak further, let us start our discussion and listen to the participants' comments. Assalamu alaikum wa rahmatullahi.
Thank you, Dr. Basim. Thank you, Dubai Islamic Bank, for your cooperation and support. Now, and without further ado, let me invite to the virtual floor Mr. Harun Tabriz, Senior Consultant Researcher at AOFI, who will present the exposure drafts and walk you through its main content while answering your question in an interactive session. Brother Harun, the floor is yours.
Thank you very much. I hope everyone can hear me.
Yeah, we can hear you.
So, yeah, thank you. Thank you, Dr. Kasim, for the encouraging words regarding EOFI. And we would be happy to hear your comments on these two standards. Let me share the screen now. So today we have a heavy agenda. We would be discussing two standards. The first would be, maybe I have. Apologies, I shared the wrong standard first. Let me share the correct one. So we would be discussing two standards today, the deferred delivery sales and the Istisna development contracts. So I would start with the deferred delivery sales standard first. Let me walk you through this standard. A couple of housekeeping rules before. Kindly use the Q&A tab if you want to ask a question, because Sister Aura and Sister Saira would be monitoring this Q&A tab. Please don't write in the chat tab because we will not be monitoring that. So any questions should only be in the Q&A tab. Now, as Dr. Kasim explained, that deferred delivery sales is one of the important contracts in Islamic banking. Specifically, Dubai Islamic Bank is working a lot on these contracts. Previously, we had two standards, Financial Accounting Standard 7, that was Salam and Parallel Salam, and Financial Accounting Standard 10, that was Istisna and Parallel. Now, due to the revision project of AOFI that is going on since the last 4 or 5 years, where we have introduced new standards and revised the previous standards, we thought of revising the Salam Istisna standards, and the discussion was that put the Salam and Istisna standards should be separate as before, like FAS 7 and FAS 10, or we should find out a model where we could actually use the deferred delivery sales concept and make up a standard regarding that. If you recall, when AOFI revised Financial Accounting Standard 28, that is Murabaha, the new standard was not only on Murabaha, it also covered deferred payment sales. So in this same value, we thought that the deferred delivery sales and development contracts should be combined to be one standard. And the today's discussion would be based on this deferred delivery sales concept. Now, Dr. Kasim has discussed Salam and Istisna very generally. So I would not be going into the Sharia details of that. Salam and Istisna both are deferred delivery sales, where payment is made in advance and delivery of the goods are to be made at a deferred date. In Salam, the full price has to be paid on the spot, whereas in Istisna, it may be allowed that you can pay in installments based on certain performance obligations. We will discuss these obligations when we will go through the standard. Now, first, why we thought of reissuing this standard? The reason was that AOP introduced the new conceptual framework in 2020 and revised financial accounting standards 1 also. Certain terminologies were harmonized. For example, we came up with this quasi-equity concept, which was not there in the previous standards. And we also tried to align all our standards with IFRS as much as possible. So the concept is that AOP would prescribe an accounting treatment only when there is a Sharia impediment in adopting the treatment applied by IFRS. So we can say that wherever it is possible, we are aligned with the accounting treatments of IFRS. Now, Financial Accounting Standard 7 and Financial Accounting Standard 10, they were one of the earlier standards issued by AOP. So the terminologies used was not according to the recent terminologies that are used by the recently issued accounting standards. So that was one of the concerns. And the second concern was that being an early standard, both Financial Accounting Standard 7 and Financial Accounting Standard 10 included Sharia factors also. Now, you should remember that initially AOP issued financial accounting standards, which included the Sharia stipulations. But later on, it was decided that we should have a separate Sharia standard and a separate accounting standard. So while we were developing this standard, we made sure that Sharia aspects which are covered in the Sharia standards are not duplicated in this accounting standard. Now, this revised standard combines certain aspects of both Financial Accounting 7 and Financial Accounting 10. There was a discussion that both of these products are deferred delivery sales. So would it be possible if we create one accounting model which can cater to both of these transactions? So the result is that now this standard deferred delivery sales includes the Salam transactions and Istisna transactions, but does not cover those Istisna transactions which are development in nature. We will cover this in the next standard, which is the Istisna development standard. So the delivery sales, deferred delivery sales, both Istisna and parallels and Salam are included in this current standard. We have discussed that Sharia requirements are not here. Let me remind everyone that this presentation is coming from the standard itself. It is nothing else than the standard, and the standard is available for reading on IOF's website. You can download it and read it. So this standard is actually the wordings which are used in this presentation is actually the wordings which are used in the standard. Now, the objective of this standard is to prescribe the appropriate accounting and reporting principles for recognition, measurement, presentation, disclosure of deferred delivery sales transactions. And deferred delivery sales includes both Salam and Istisna transactions. And the new standards prescribe accounting treatment for both the buyers and the sellers. For the counterparty transaction is also included in this standard. Now, the scope of this standard is applicable to deferred delivery transactions carried out under Sharia principles and rules by the Islamic institutions, the Islamic banks, and other institutions which follow AOP accounting standards. The scope does not include those istisna transactions that are development transactions that we can see that they include extent of work. We will discuss this later in the presentation. So development contract is another standard, and we are only discussing the deferred delivery sales here. Now, this standard does not include where the buyer develops and lease out the subject matter according to Ijara Muntahiya with Tamliq arrangement, because this would cover in Financial Accounting Standard 32, which is Ijara. Or the buyer is developing a subject matter for its own consumption, for own use, self-use. So this is also not covered in the standard. So we are only discussing sale transaction where trading is happening. Trading means where you are making something and selling it. The definitions section includes certain definitions. Before starting on definitions, let me clarify that the main accounting of Financial Accounting Standard 7 and 10 has not been changed. It is only clarified. So these definitions are clarification of the old definitions which were in the previous standard. We have not included anything that is new except for the development part, which we would discuss in the next step. So deferred delivery sale is a sale transaction which is carried out in line with the Sharia principles and rules, which could either be a Salam transaction or a Istisna transaction. And in this, the primary performance obligation is delivery of the subject matter. Subject matter could be a crop in case of Salam. A subject matter could be garments in case of Istisna, which is for export purposes. Deferred delivery sales do not include a transaction that is promised to be carried out on a specific future date against a unilateral promise. Because this future promise would be covered in the Wad, Khiyar, and Tawad standard. This is not in the scope of deferred delivery sale. The sale has not happened. It is just a promise. So it would be covered under the Wad transaction. Istisna is a contract to sell a described asset. Described asset means it must be a specified asset with deferred delivery under a manufacturing request. Usually you would request to make a specified asset, to manufacture it, construct it in case of a building. In practicality, it is a sale contract between the buyer and the seller, whereby the seller, based on an order from the buyer, undertakes to manufacture or have it get manufactured or otherwise the subject matter of the contract according to the specifications from the buyer for an agreed upon price and method of settlement, where in advance by installments or deferred to a specific future time. So in case of Istisna, you would be manufacturing a specified asset. In case of Salam, it will not be a specified asset. It would be an asset which is homogeneous which is easily available in the market. So the Sharia differences of Istisna and Salam would remain there in this definition. We have created a new definition, and that is Istisna-based development contract. Now, these are the contracts which would be covered in the next other standard, which we would be discussing later. The definition of an Istisna-based development contract is coming in from the other standard. It says that it is a contract for development of an asset. It could be a property, plant, and equipment item, which meets certain criteria. Now, these criteria are the differences from the current standard and the other standard. It involves a significant element of effort on the part of development, which could be labor and services. And this effort needs to be compensated in case where the delivery is not made. We would discuss this aspects when we would be discussing the next standard. The second characteristic is that Istisna-based development contract has either an element of partial control transfer through milestones-based delivery on the customer's own property, or otherwise defines multiple performance obligations as part of the contract. And these performance obligations, they could be individually assessed or used as criteria for determining stage of completion. So we can find out in an Istisna-based development contract which stage of development we are, what is the percentage of completion of this project. And the third characteristic is that the subject matter is intended for specific needs of an identified unique customer, and hence may generally not have a ready market or may not be in a condition suited for its sale to a third party. Only one customer could use it. This type of property, construction, manufactured plant and machinery is usually not for sale in the open market. It is only made for a specific customer. There is a hand, Obed. Someone is asking a question.
Yes, brother, there are a couple of questions in the Q&A tab, and plus
Yes,
we have, like, people have raised hand in both in the panel
So-
as well as in the attendees.
So if you can take me through the questions one by one.
The first question is by brother Makawi Ismail. Assalamu alaikum wa rahmatullah. First, I would like to thank AOP very much for inviting us to attend this public hearing. My question is about deferred delivery sales. The definition 5A did not include some sales promised to be carried out on future dates. So under which other AOP standard?
Brother, the quick answer is that if it is a future promise, sale would happen at a future date, which is not included in Istisna or Salam, then it would be covered under the VAD financial accounting standard. VAD Khiyar and Tahawwur.
Another question is by brother AKM Miznur Rahman. My first question is, as per regulatory requirement, any finance to be reported in the name of customer, it is applicable for advance salam payment, but in case of sale through agent or directly on deferred payment basis, can we say it financing? If yes, how?
Actually, this would be covered under the governance part. This is actually not a accounting concept. So we would actually discuss this towards the end, because right now we would be focusing only on the accounting issues.
Brother Arsalan's team has raised their hand in the panel. Should we let them
please,
ask the question?
Brother Arsalan.
Assalamu alaikum. Thank you very much. I have question related to scope of this standard. It is mentioned that this standard shall not be applied to such transaction where the institution being buyer of subject matter has intention to lease out or eventually sell the asset. So when we, technique practically see the transactions, how the products are structured, standalone istisna and salam, they don't work, right? They are always clubbed or supplemented with lease
Yes.
or sale at the end. So what I understood from this statement, if let's suppose there is istisna with forward ijara or if there is salam with sale, this standard shall not apply in that case. If that is the
No,
situation, then what would be the treatment during the phase of salam or istisna? It's not
no,
clear
no,
in this.
no, brother. We would actually discuss this later in the section. Yes, you can club it with a murabaha transaction. So, salam or istisna plus murabaha could be there. But when you lease out an asset, transfer ownership, then it would be coming under the Ijara standard. And Ijara standard is separate, separate from here. So yes, we can actually have istisna or salam contract coupled with a murabaha.
My question was, if we look at the scope currently mentioned there, it
Yeah.
says if eventually the intention is to lease or sell, this standard shall not apply, which means because all the products are structured in this manner.
Okay.
So apparently it gives a meaning that this standard shall not apply in
brother,
such case.
yeah. It actually is based on if you own it or if it is you want to use it for yourself. If you look at part B, use the subject matter in its own operation, self-use or self-consumption. When you lease out an asset, you own that asset for the lease period and then you eventually sell it. Right. So both of these, according to the accounting model, would be the same. You would actually be using it for your own purposes, even when you are leasing it out or whether you are self-using it.
Harun,
Yes.
Harun, this is me and Azir. I think what Arslan is trying to get at is that there are two components. One is the disbursement that may occur under sale istisna or a salam, and typical financing structure. And that servicing contract could be either a lease or a sale transaction pursuant to an agency. So if we differentiate between, we specifically exclude in this standard the second leg or limb of the transaction, then the standard on a standalone basis does not work, and it will create an arbitrage or a gap. And this will also, in a jurisdiction where IOP standard, Sharia standards are a minimum standard for Sharia compliance with respect to enforceability of the Sharia nominated contract, this will create a big issue of enforceability of that Sharia nominated contract. So I think we need to, have a reasonable level of, of acceptance of this statement as well as this definition.
So, brother, Sister Saira, can you just record this comment?
Brother Harun, as Aslan mentioned, on a standalone basis, this does not work. There's, either you are buying or you're selling. Two aspects. Yes.
May I add one thing? This is Dr. Qasim.
Yes.
As a matter of fact, my colleagues, Brother Mia, Brother Arsalan, they are trying to highlight the fact that if you say this, effectively you are saying that this will not apply to salam and istisna as used by Islamic financial institutions. So why should we be involved in it?
Okay. So I can understand your issue, and I can understand that this wording is actually creating a problem. So Dr. Qasim, thank you for this comment. We would look at the wording here because, the concept that we want is not coming out like you are saying, right? So it
I would
actually may
also-
create a problem.
And I would also suggest or recommend to AUFI that whenever
Yeah.
they work, particularly at the working group stage, before the standard is submitted to the board for review and approval. I think you have some practitioners, but there should be at
Yes.
least somebody who is expert in drafting legal wording and also a Sharia scholar. I didn't see any Sharia scholar that I know. You may have, I don't know, because most of the names I'm not familiar with them. Is there anybody, a Sharia scholar in the working group?
Dr. Kasim, what happens is that the accounting board reviews the standard, and then it is sent to the Sharia committee of the Sharia board, AOP Sharia board. So at least 4 or 5 Sharia scholars who are on the Sharia committee, they go through the standard word by word. I am not sure that this process has been done because sometimes we do the public hearing before sending it to the Sharia committee, and sometimes it is afterwards. Public hearing is just the objective of public hearing is just to get comments from the public about the suitability of the accounting treatment, right? So
During the development, the process of developing the standard.
Yes. So this is part of the. So this is part of our due process that all accounting standards needs to be vetted by the Sharia committee of the AOP Sharia board. So, because Sharia is supreme, it is paramount, it would actually come in. So this standard would also go there. So Sister Saira, can you just note down this comment that we need to look at the wording and see whether it clashes with the sale and lease by transactions, right?
Right, noted.
Right. There were other questions also. Thank
The
you,
other
Dr. Kasim, for the clarification. We really.
The other questions in the Q&A tab pertain to the later part of the
Okay.
exposure draft, not to this part. There
Not
are
this
two
part. So,
attendees who have raised their hands. Should we give them the mic or
yes,
should we
please,
ask them to write in the...
I think we can give them the mic. We have time. Yes.
Mr. Affan Zafar.
Brother Afan Zafar, can you please ask the question?
Mr. Ubaidullah. Mr. Ubaidullah.
If you're not able to use the mic, then you can actually write in the Q&A tab. Read the question there also. So we can take the questions later also. Or we will just record it. I'll continue if you permit. The next definition is a parallel salam, which is an arrangement whereby the seller enters into an independent salam contract. And this is the important part where salam and parallel salam are two independent transactions, two independent contracts. And if you look at the definition, the first salam without making the execution of the second salam contract dependent on the execution of the first one. In contemporary customs, such second contract is usually called a parallel salam. And in practice, we can change the sequence of the transactions. We can do the parallel salam transaction first and the salam transaction afterwards. So these are the two different contracts which have no no a relationship with each other except for the subject matter. The subject matter of the first contract would be sold in the parallel seller contract. In the same way, we have a parallel istisna arrangement whereby the seller or developer enters into another independent istisna contract with a third party. So there is one istisna contract between the customer and the bank, and the second contract, which is a parallel istisna, where the bank would sell this to a third party, or it could be the other way around. And these two independent contracts, except for the subject matter, are completely independent of each other. So you can change the sequence of these transactions. Salam is a sale of pre-specified commodity for deferred delivery in exchange for immediate payment in full in line with Sharia principles and rules. We have given an explanation here that it is a type of sale in which the price, which is usually known as the capital, is fully paid at the time of contracting while the delivery is deferred to a specific time in future. Now, this standard covers deferred delivery sales both in the books of buyer and the seller. We would be doing the recording in the books of the buyer first and then in the book of sellers. So the counterparty transaction is also covered in this standard. Now, in Salam transaction, whenever an advance is made by the buyer to the customers, it is recognized in case of a Salam transaction at the time of entering into a Salam contract as advance for Salam goods, equivalent to the amount of cash paid. So if you have paid $1,000, it would be recorded as advance for Salam goods. In case of Istisna, as and when the advance payment, in Istisna and Salam, the difference is that in Salam, you have to pay the full amount. In Istisna, it would be the lump sum, or you can pay in installments depending on the contract. It is also recorded as advance for Istisna goods. So when you are making the payment, revenue is not recognized. Only an advance against delivery of goods is recognized. So you would record advance cash payments. When the inventory is acquired after making this advance payment, it shall be recognized by the buyer once it controls the subject matter of Salam or Istisna transaction. And control is coming in from the control standard, which says that the control is when you essentially acquire the risk and rewards incidental to ownership of the subject matter. So once the risk and rewards are transferred from the seller to the buyer would record inventory in his books. Initially, inventory shall be recorded at cost. The standard identifies that the cost is the cost of purchase to bring the asset to the present condition and location. You can add the taxes which are not recoverable. So value added tax is not part of this. Any tax which is not recoverable needs to be added. Transportation and handling costs, including other costs attributable to bring the subject matter to present condition and location. It also includes the trade discounts, rebates, performance bonus, and similar items, if any, which needs to be adjusted with the costs. So the cost is usually the same, which we recognize for all assets, even in Muraba standard. Any cost to bring the asset to the present condition and location. Now, In case inventory is acquired on a piecemeal basis, where you get one part of inventory in one tranche and the next part in another tranche, the risk and reward is being transferred piecemeal. So you would record this according to the risk and rewards being transferred, which are covered in paragraph 8. This condition should be met. Now, subsequent measurement for advances for Salam goods and advance for Istisna goods, they should be carried at their outstanding amount, less any allowance for impairment. And outstanding amount represents the gross amounts of advance for Salam or advance for Istisna, less inventories received or any adjustments, including recoveries, discounts, rebates, and performance bonuses, if any. Now, the thing to note here is that if you look at 10, we have written that the gross amount of advance for Salam goods and Istisna goods shall be carried at their outstanding amount less allowance for impairment. Because this advance is would be converted into goods when you would receive the goods. You will not collect money against this advance. This is advance for goods. Therefore, the allowance for impairment is used. So credit losses, expected credit losses would not be accounted according to the AOP financial accounting standard for this type of advance, because you would not be getting cash, you would be getting goods in return. So impairment would be tested for these goods. Allowance for impairment, if any, shall be accounted for according to the FAS 30 impairment credit losses and onerous commitments. A delay in or inability of seller to perform delivery shall be considered as an objective evidence of impairment. So if there is a delay or the seller is not able to make the delivery on time, then you need to check the impairment because the value of this good may have gone down, and there could be an impairment in process. Inventories are subsequently measured based on the lower of cost or net realizable value. Now, determination of any adjustment to bring down the value of inventories to the net realizable value, it would be once again treated according to FAS 30, which covers this impairment, credit losses, and onerous commitments. A delivery of the subject matter which does not match the contractual specifications and you have accepted it, then you need to reassess the net realizable value because it is not according to your specifications. So the value may have gone down. Any additional handling or holding costs of inventories, they are not to be included in this value. They would be charged to the profit and loss account for the period. And this is in line with the accounting treatment of inventories that we do. Inventory would be de-recognized. You would take the inventory out of your books when the control is transferred to the eventual buyer in the form of sale. So when you have sold off this asset, you would de-recognize the inventory. In case the control is lost, there may be a situation where you have lost the control due to theft or a physical damage or destruction. Then also you would de-recognize the inventory, or these lose their capacity of providing future economic benefit. For example, technological obsolescence, legal restrictions, or if there is no expected benefit, you cannot sell it to any party because of legal restrictions. Then you would de-recognize the inventory and record a loss in your financial statements. Now, advance for Salam goods and advance for Istisna goods shall be derecognized when the delivery happens. So once you receive the subject matter, if it is specified, then whenever you have received the specified subject matter, or sometimes if it is substituted with mutual agreement, then also you would derecognize the advance and record the inventory. When the subject is no more deliverable and advance payments there against are refunded with mutual consent. In case the transaction is not happening and you have repaid the advance, then you would derecognize it. Or when due to the seller's insolvency or other limitations, the advance cannot be recovered. And when the buyer waives its rights by writing it off or gifts it as hiba to the seller. So these are the conditions where the advance needs to be derecognized from the books of the seller. Revenue
There are a
and
couple of
profit.
questions
Yes.
related to these sections. So there's a first question relating to para.
Sorry, Sarah, I cannot hear you.
Sorry. In case of point 16 of deferred delivery sales, why handling costs related to inventories will not be charged to inventories? Why will it be charged to statement of income?
So let me go to paragraph 16. So this is the additional handling and holding costs relating to inventories, which you are incurring because you are keeping the inventories in your possession. This is not the inventory that, this is not the cost that was put in for you to bring the inventory to your premises. So this, just like in case of a manufacturing concern, would be considered as a revenue expense. It is not included in the cost of inventories. You know, the holding costs when you have received the inventory and before you would dispatch it to the seller. Now, this would be very rare because you know, you would make the customer the agent and sell it from their premises. So usually you will not have these handling costs. But in case you you get these inventory items in your premises, then any further holding costs will be charged to the profit and loss.
So another question is on 17C. Is it possible to not having any expected buyer in case of Sanam or Istisna?
Now, Salam and Istisna would be between the customer and the bank. What do you mean by buyer? If you can just clarify this. What I understand is that you are asking that the bank receives Salam goods or Istisna goods without having a buyer, but this does not happen in reality. You would actually have a buyer first and then you would get the Salam goods.
If I'm permitted to intervene, brother
Yes,
Harun.
please. Yes.
So is it not more appropriate to delete this? Why should we say something which will create some confusion?
Because the underlying assets are not identified assets.
So if we purchase something which has no expected buyer, then I think the management of that financial institution should be taken to task.
That's true. That's true. Sister Saira, please note this down. This is a very good point. Thank you. Thank you very much for this. We should actually delete this because, you know, this transaction will not happen if you don't have any buyers.
It's going to be very hypothetical.
Yeah,
Just
purely hyper. Yes.
With respect
We
Because
are living in a real world, and we are discussing.
legal
Yeah.
restrictions would work because there may be a restriction after you enter into a contract.
Yeah,
So
because of
it would-
certain,
Yes.
for any reason, security reason, or for any a sovereign decision can come and just stop you from selling something, or the restrictions on certain buyers.
Buyers,
On number
yes.
16 also, Brother Harun, the
he also doesn't make sense.
this number 16, any additional handling and holding costs related to inventories. For example, if we are going to sell the asset acquired through Istisna by way of Murabaha, so then how will I reach at my actual cost? In this case,
brother-
you are excluding it.
Brother, what happens is that the cost of inventory is usually till the time you have received it. So inventory would be recorded at the cost when you receive it in your premises. Any holding cost afterwards will not be included in the cost of inventory. That would be charged to the P&L. So I received goods in my godown on 1st January 2024. Till that day, the cost was $10,000. But now I'm keeping it for one more week in my godown and there is a handling cost. This will not be cost of inventory. This cost would be charged to the profit and loss. Now this
I understand.
is a
But
very
this
rare
is the
situation.
kind-
This is a
No,
very
this
rare
is-
situation, but it may
I
happen
understand, but
because
sometimes I may be forced by any circumstances, particularly maybe by customer, by delay by the customer to take delivery from me, I need to hold it. So it is a
Hold it.
direct cost.
it is not, it will not be the cost of inventory. You will actually charge it to your P&L. You cannot increase the cost of inventory by
The P&L, when I charge it to the P&L, it means that I'm going to take the hit. I'm not going
You
to
will
pass
going
it on to the customer, despite the fact that it is because of the customer that I have been holding it for another week.
But
So I think just highlight it, please. I
yes,
think
okay,
maybe
we can.
better
We can-
judge or forum to.
Yes. So Saira, we would highlight it for discussion in the working group that what type of situation could be there, and maybe we would explain it in a more. Thank you, Dr. Kasim, for the valuable comments.
Still have. Go back to brother, if you could kindly go back to the where you mentioned the three limb of this one. The control is lost, e.g., in the form of physical loss or theft. So these are almost scopism assets technically until the delivery or the settlement or termination of the contract. You know, these are still deliverable assets.
No, but it has become
Brother, you have recorded the asset as an inventory. You have received it. That's why you have recorded in your books. Now, after your recording, the control is lost. Yes.
After the delivery, this is after the delivery.
Yes, this is after the delivery.
becomes inventory. Yeah.
Go back. Thank you.
Right. So should we proceed?
Proceed. Go ahead.
Please.
Yeah, thank you. Thank you. So coming to revenue and profit recognition, revenue shall be recognized at gross value at the time of sale of the subject matter. To the eventual buyer, it could either be directly or through an agent, which shall coincide with the time of transfer of control of inventory. We have discussed that in 17A. And there is an explanation here that the gross revenue shall be the total amount billed to the eventual buyer directly or through an agent without any deduction of agency fee or incentive payable to the agent. So we will not show the net revenue after deduction of agency fee. We would show the gross revenue. And there is a second explanation here, that is, buyer shall not recognize any revenue, hence profit, till the time the subject matter of Salam or Istisna is not sold to the eventual buyer. So you will record revenue only when the risk and rewards have been transferred from you to another party. And you have transferred the control. And this should be at the gross amount. This should not be at the net amount. And the reason is that any payment of agency fee is a separate contract. This is not part of this contract. And we cannot combine two contracts into one accounting transaction. So, making a payment for agency fee is separate. It should be recorded separately, and the revenue should be recorded separately. Agency fee could be fixed or it could be variable as an incentive. It shall be accounted for in a separate from the gross revenue arising on the transaction, and it will not be netted off. Now, goods purchased under deferred delivery sale contract sold on deferred payment basis. So in case where the subject matter is purchased under a deferred delivery sale contract, and then it is sold to an eventual buyer under a Muraba or another deferred payment contract. So, a Salam contract or an Istisna contract with a Muraba sale contract or any other deferred payment contract. The revenue shall be recognized in line with the requirements of the respective BOP phases. In that case, we would use the Muraba and other deferred payment contract and recognize the profit over the period of the transactions. Because it's a deferred payment transaction, you would get payment at the end or in installments, and you need to amortize this profit over the period of the transaction. This is covered in Financial Accounting Standard 28. So the first transaction is Salam or Istisna, and the second transaction would be a Murabaha, where you are selling this asset to a customer, to a buyer on deferred payment, and you would record this according to Financial Accounting Standard 28. Now, presentation and disclosure requirements are given in Financial Accounting Standard 1, which is generally the general presentation and disclosures in the financial statements. But this standard also adds certain things to that. You need to provide the accounting policies which are adopted for deferred delivery sale. Recognition of Salam and Istisna goods, inventory, revenue, cost of sales, profit. So the accounting policies for recognition of all these items. Then the disclosures in respect of purchase of subject matter, which would be the advance for Salam goods. If the full payment is made, advance for Istisna goods, full or part payment is paid, commitments, liability in respect of outstanding amounts, if there is any impairment or not, net realizable value of inventory. We discussed that inventory needs to be at lower of cost or NRV. Then we need to give appropriate disclosures for sale of the subject matter under agency or parallel deferred delivery sale contract. What is the amount of sale which is bifurcated between receivable from the eventual buyer and the agent, and revenue and profit recognition, and any credit loss in the second leg of this transaction. This would be recorded according to Financial Accounting Standard 30, impairment, trade losses, and risk accounts. And then presentation and disclosure continuation is that any unamortized deferred profits against deferred delivery sales receivable respectively, providing a movement of the same during the period duly disclosed as a deduction from the outstanding amount of gross receipt. So if there is any deferred profit against the deferred delivery sales receivable, it would be recorded as a deduction from this and shown as a separate line item. And if there is an onerous commitment, it would be shown as onerous commitment according to Financial Accounting Standard 30. The balance of the advance for solemn goods and advance for istisna goods and outstanding payables, it shall be presented on the appropriate side of the statement of financial position without netting off. And where amounts are material, the disclosures mentioned in paragraph 22 may separately identify between solemn and istisna in the notes of the financial statements, considering the different risk factors associated with them, respectively. So the risk profile of both transactions is different. Therefore, where the amounts are material, the disclosures should identify whether it's a solemn transaction or istisna transaction. And where the contracts include a parallel element, where there is another transaction to sell solemn or istisna goods, they should be separately identified with amounts. Now, let's come to the deferred delivery sales in the books of the seller. Sarah, is there any question for the part that we have covered?
There is a question, which is, what will be the accounting if goods are sold through agent?
What will be the accounting if the goods are sold through an agent? Brother, this would be a normal sale transaction. You would be selling it. The agent is considered in view of the principal, so you would be selling it. I don't think any other question is there, so let's proceed to the next part, which is deferred delivery sales in the books of the seller. Now, solemn or istisna goods deliverable would be recorded in by the seller. You have received cash from the buyer, so this cash would be recorded in case of solemn transaction at the time of entering into a solemn contract as solemn goods deliverable. You will not be making a cash payment, you will be giving goods. So you would record this amount as solemn goods deliverable, which would be equal to the amount of cash that you have received. And in case of istisna, you would record this as istisna goods deliverable, again, which is equivalent to the amount that you have received. When you deliver the istisna or solemn goods, then you would record this as a sale transaction. But subsequent measurement of solemn or istisna goods deliverable would be a liability against solemn and istisna goods, and it would be measured at its outstanding amount. You would not record any impairment on it. Onerous deferred delivery sales contracts may be possible. There may be a situation where under a deferred delivery sale contract, there is a possibility that you will incur a loss in future. So if there is a loss in future, you would record it as a onerous commitment according to Financial Accounting Standard 30 and record it on the current date. Inventories usually are subsequently measured based on lower of cost or NRV. Now, in this case, generally accepted accounting policies shall be applied in respect of accounting and financial reporting for inventory intended to be sold at a later date. So AOP does not have their own standard for inventory, and in that situation, the hierarchy provided in paragraph 7 of the AOP conceptual framework, it says that if there is no accounting standard issued by AOP, or if similar accounting is not provided by a financial accounting standard issued by AOP, then you need to follow the generally accepted accounting principles. So you may use the IS2 if you are using IFRS as your generally accepted accounting principle to record inventory. And this is the same as AOP prescribed inventory item, which is lower of cost or NR. The revenue shall be recognized at gross value at the time of sale of subject matter to the buyer, which shall coincide with the time of transfer of control of inventory. So revenue would be recognized only when you transfer the inventory. Till that time, it would be shown as advance for Salam or Istisna goods. In case of Istisna, where full or part of the price is to be received on deferred basis, then you may defer the profit and recognize it over the period according to Financial Accounting Standard 28, which gives you the effective profit rate method to allocate profit over the period of time. And now we come to the presentation and disclosure in the books of the seller. In addition to the disclosure requirements as stated in Financial Accounting Standard 1, we need to give the accounting policies, deferred delivery, sale transactions, Salam Istisna goods deliverable, inventory, revenue, cost of sales, profit, liability that is against Salam or Istisna good deliverable, inventories that is held for deferred delivery. It needs to be distinguished according to classification. We have discussed that both Salam and Istisna have unique characteristics. So any inventory for Salam has to be differentiated from inventory held according to Istisna transactions. Inventory which is intended to be held for longer period may have certain risks, and you need to identify those risks in the disclosures. Sale revenue, cost of sales, profit resulting from the deferred delivery for the financial period. And if it is a deferred delivery sale, then unamortized deferred profit would be there, which you need to show the movement of this from the opening balance till the closing balance. And if there is any impairment, you need to give the allowance for impairment and any credit costs. The balance of receivables and good deliverables shall be presented. If there are material amounts, then you need to disclose separately between Salam and Istisna transactions, and where the contract has a parallel element, parallel Salam or Istisna, then you need to identify that the original transaction has a parallel element and give the disclosures for that also. So
Arun, if you may allow me, can you go back
yes,
to rule number
yes.
34? Where amounts are material, the disclosures mentioned in paragraph 32 may separately identify between the Salam and Istisna transactions in the notes. Don't you think that this may need to be rephrased? Just highlight this.
Okay, Sister Sarah, we can actually make it better. We can always improve the verdict. But Dr. Kasim, you can understand the objective. Objective
Yeah, I
is
understand.
that
I think
yeah.
I don't want to recommend anything. Leave it to them, but I think it may.
Yeah.
There is some room for improvement. So always identify comes with an object. Identify between the Salam and Istisna transactions in the notes.
Right. So we
Instead
will
of identify it may be differentiate or something. But we'll leave it to that.
Okay. Okay. Yeah. So in Sister Sarah, just note that for identification, we may use a better word. Sister Sarah, can you hear me?
Noted, brother. I agree.
Yeah.
Yes,
Thank you.
noted.
Thank you, Dr. Kasim. Yes, we would look for the right word because you are absolutely right. Identifying does not actually cover the whole topic. So thank you for this.
You are welcome, brother. Jazakumullah khair.
So we have discussed that parallel salam and parallel istisna, they are independent transactions from salam and istisna. So if there is a parallel salam, we would record it separately as a buyer. The accounting would be the same for buyer and seller as we have discussed it. And the same goes for parallel istisna. The name parallel is there, but actually it's another istisna contract with the same subject matter and the same salam subject matter. Now, in case where there is a subsequent change in price of the subject matter with mutual consent, it would be considered as an event taking place at time of such agreement of change and shall not give rise to a gain or loss at that time. The eventual profit and loss and the change shall be recognized only or once the sale to the eventual buyer is made. However, such a change event may be considered as an objective evidence of impairment or necessary adjustment for net realizable value. So this change with mutual consent considered as something happening at the time of such agreement or change. We will not record a gain or loss at that time. This gain or loss would come in when we would actually recognize the sale to the eventual buyer. So this would translate into the new price being taken from the buyer. And in case there is impairment, we would need to record the impairment on the date. There could be a change in price of the subject matter of Istisna contract based on performance. A change in price of the subject matter of an Istisna contract based on performance. You are not meeting the delivery target. There is a delay on the delivery date. And this may be according to a pre-agreed mechanism defined under the contract. It shall be accounted for in line with the requirements of paragraph 38, which states that this will be recognized when the eventual sale happens. It will not be recognized on the day of the change in the price. Now, this standard is applicable on or after 1st January 2027. This date would be proposed to the board, and if participants think that this needs to be changed, you are always welcome to give comments on that. The date should be maybe 1st January 28 or maybe earlier. But this is the date that is being proposed to the accounting board for adoption. We'll skip this part where the amendment is coming in. There is a process flow given at the end of the standard, which you can look at according to the process. So this covers the first standard, which is deferred delivery sales. Sister
There are
Sarah.
two questions. Brother, there are
Yes,
two questions. One question is on the process flow.
Yes.
process flow for
Fine.
deferred delivery sale, point number D, is it possible to sell back to the customer? Sell back to the customer?
Okay, now this is a Sharia issue. So, Dr. Kasim, I may request you to answer it.
Assalamu alaikum wa rahmatullahi wa barakatuh. As a matter of fact, when you purchase something from a party, if you stipulate in the first agreement that you would sell it back to the same party, this is not permissible. But if it happens that you purchase it from a party for yourself or to sell it to another party or for any other reason, and then after you take the delivery, or even, I'm sorry, when you take the delivery and you sell it to the same customer under certain circumstances, there is no Sharia bar on such a sale, provided it was not stipulated, it was not a condition in the first scene, and it was not part of an arrangement, even if it was not stipulated over there, but it was understood or committed by the customer, by the seller, the first seller, that he will buy it. Yes, if it is under a separate promise to purchase under certain conditions, this can be an obligation of the customer to purchase, but he can at any time he may renege or back out from his promise. So it is not a sale, the conditions. This is the Sharia position on it.
Thank you very much, Dr. Kasim. Thank you. I hope this answers the question.
Barakallah.
One more question. What will be the accounting treatment in case the seller is unable to deliver the salam or istisna goods by delivery date? Subsequently, the similar goods should be bought in market?
Yes, brother. Subsequently, he needs to arrange it from the market and then deliver it to you. In that case, there may be a situation where the goods may not be of the specified condition. And we have discussed that then this is where you would assess it for any impairment. But yes, you can actually arrange it from the market and give it. So considering we don't have any other question, let me.
Brother Arsalan has raised his hand. Is
Brother Arsalan.
is there a question?
Yes, I have one comment, in fact, suggestion with respect to inventories disclosure. So the current treatment is perfectly fine, lower of cost or NRV, it's aligned with IFRS as well. However, as we know that most of the financial institutions, when they calculate their zakah, and for the purpose of zakah calculation, market value of the asset is required, and I think both of these inventories, whether it's Tisna Salam, they will qualify for zakatable assets. So
Yes.
in the situation where cost is less than NRV, I would suggest that disclosure should be required, that institution must disclose the market value of the inventory, whether it is recorded at cost or NRV, disclosure should be there. So it will be easier for the person who is calculating zakah to properly calculate zakat for the institution. This is specific to these two standards as well as to other standards like
Other
Muraba
standards.
if they go for revision in the future.
Thank you, Brother Arsalan. I think this is covered in the zakah standard presentation and disclosure also, but we will recommend to the working group to make this part of this standard and the development standard also, just a reference to that, so that, zakah calculation is easy. Thank you very much for this.
Thank you.
Sister Sarah, is there any other question or should we?
No, there's no further question.
Right. So let me start with the Istisna.
Sorry, Sorry, Brother Harun, there's one question. If the
Yes.
Istisna asset delivery is delayed due to vendor issues, or if the vendor has to be replaced, is there a standard which guides the FI on penalty that can be levied on the vendor?
This would actually come under governance or Sharia. I don't think so, Sharia, but maybe governance. Marjan, am I right?
Yes, brother, because yes,
This would be
penalties we've
part of
not discussed here, yeah, on the vendor.
yes.
Yes.
Dr. Kasim would correct me if I'm wrong, but we cannot have a standard on what type of penalties could be levied. This has to be done by the Sharia board.
Brother Harun, this is Omar from the IB. Dr. Kasim is currently
Okay, great.
in Kenya.
Okay, occupied. No problem.
Maybe.
Thank you. So, starting with the next standard, that is Istisna-based development contracts. I'll skip the preface because this is almost the same as the deferred delivery sale contract. Both of these standards, they share common items. So we'll just skip that and go to the main part that is relevant. Why we issued this standard, we have covered this. Now, the change here is that deferred delivery sale transaction based on Istisna, which is short term, has been included in the deferred delivery sales financial accounting standard, which we covered just now earlier. This development standard only talks about the Istisna products, which have considerable effort to develop. With this is covered in the definition of development. We will cover that. So the development standard is only applicable for Istisna transactions, which exhibit the characteristics of a development. This is not covering the deferred delivery sales, which is covered in the earliest. So let me skip this also. We have covered that. So let's jump into the scope directly. The standard applies to accounting and financial reporting for Istisna-based development contracts. And the definition is given in paragraph 5. We have already discussed it when we were discussing the previous standard. And there are certain Istisna transactions that are excluded from the scope in paragraph 3. So these transactions do not meet the criteria for an Istisna-based development contract and hence are subject to accounting as a deferred delivery sale transaction, which is covered in the earlier study. Such Istisna transactions have a total development period of less than 12 months. So if it is a development project with a development period of less than 12 months, then also it will not be part of the current standard. It will be part of the deferred delivery sale contract. So in this standard, we only would cover those Istisna development projects which have a development period of more than 12 months. So Salam transactions, Istisna transactions, which are plain deferred delivery, and any development Istisna transactions which are of less than 12 months are covered in the deferred delivery sale financial accounting standard. The institution, being a customer of Istisna-based development contract, has intentions to either lease out and eventually sell or otherwise transfer the subject matter under Ijara Mulki or use for its own operation. Saira and Marjan, please also check it out because this is the same wording that is coming in from the previous standard, and Dr. Kasim had a view on this. So we will
Yes.
mark it here also.
Okay.
Customer in this standard is the buyer who acquires the subject matter under an Istisna-based development contract. We have covered deferred delivery, sale transaction in the previous standard. So we will not go through the definition again. Developer is the manufacturer, constructor, producer, processor, fabricator, or builder who develops or manufactures and then sells the subject matter under an Istisna-based development contract. So it could be a long-term development contract for a plant and machinery, for example, a cement plant. It could be a construction of a long-term construction project, for example, construction of a multi-story building. So in that case, the developer is the person who is manufacturing or constructing that subject. We have covered Istisna, and we have covered the Istisna-based development contract also. Parallel Istisna is an arrangement where the seller developer enters in another independent Istisna contract with a third party. This is the same as a parallel Salam. And we have discussed that Istisna and parallel Istisna are independent contracts. You can enter into any one of them. There is no sequence for them. You can enter into the second contract first and the first contract afterwards. It's up to you. Stage of completion method, at times referred to as percentage of completion method, is the recognition of revenue and expenses by reference to stage of completion of a development contract. Under this method, development contract revenues match with the development contract project costs incurred in reaching the stage of completion. So the percentage of cost that has been incurred in reference to the percentage of revenue would give you a stage of completion. And this would be worked out for the work completed proportion part. Now, first we need to find out which contracts would be coming in this standard. So Istisna-based development contract within the scope of this contract is a contract of Istisna. It cannot be a Salam contract. Salam would automatically go in the deferred delivery sales contract. It is normally an item of property, plant and equipment or an investment property, duly meeting the following criteria. The first criteria is very important, that it involves a significant element of effort on part of the developer, including labor and services. And the developer needs a compensation for that. And in the case of a force majeure, where you will not be taking the building or the plant and machinery because of any reason, still the developer would ask you to be compensated for that. So the effort part must be there in this Istisna-based development contract. It has either an element of partial control transfer through milestone-based delivery and or construction development on the customer's own property, or otherwise define multiple performance obligations as part of the contract that may individually be assessed and used as criteria for determining stage of completion. And this contract must have certain milestones, which are to be treated as obligations, performance obligations. And based on these performance obligations, you would be determining the stage of completion. Let me clarify here that previously we had International Accounting Standard 11 construction contracts, which has been now superseded by IFRS 15 revenue with customers. And IFRS usually, generally, does not recognize percentage of completion now. Revenue is to be recognized based on milestones. But in Istisna-based development contracts, this is a unique type of situation where profit needs to be recognized based on the stage of completion. So this is the reason that this development contracts have been put in this standard and stage of completion method included for revenue recognition. Otherwise, it won't be possible for Istisna products to recognize any revenue. The subject matter is intended to address certain specific needs of an identified unique customer. In Istisna development contracts, you will usually have a unique customer who wants a unique asset which does not have a ready market, and this asset is usually not suitable for sale to a third party, and it has a considerable original total development period. This development period could be a single or multiple phase period or tranches. So development period in the specific context of this definition criteria shall not be confused with or considered interchangeably with the deferred delivery. Development period is the period for development of this particular subject matter. It is not to be confused with the time when you are giving the delivery. So you may keep the asset in your inventory for an extended period of time and then delivering it due to any reason. This is not development. Development is the date from which you start constructing or manufacturing this good subject matter and the date on which you have completed it. It has nothing to do with the deferred delivery. Now, the initial recognition of development contract project cost, which is to be recognized an asset, would be based on the costs that have been incurred directly on the subject matter. Indirect overheads needs to be added to this cost. You need to exclude any idle capacity element of the fixed overheads and only take the indirect overheads that are objectively attributable to this development project, and any other costs that are specifically chargeable to the customer under the contract. This would be part of the development contract project cost, and you would record this cost as an asset in your statement of financial position. Now, general and administrative expenses, selling expenses, research costs, they are not included in this development contract project cost. So if I talk in layman terms, this is a type of work in process or a work in progress account. The costs are built into this development contract project cost until the asset is complete. And we only take the direct costs, we don't take administrative, selling, and research costs. The development contract project cost may be reduced by any incidental income, which is not included in the development contract cost contract revenue, for example, income from the sale of surplus material, income on the disposal of related plant and equipment, and services provided to third parties using the resources allocated to the development contract. So you bought raw material, maybe 10,000 bags of cement to construct a building, but only 8,000 were used, 2,000 remained. You sold them off, so you would de-recognize this amount by reducing the development contract project cost. Development contract project cost includes the cost attributable to a development contract for the period from the date of securing the contract to the final completion. of the development contract delivery of the subject material. And usually it also includes the testing period also. So if there is a trial run or something like that, this part would also be included. Costs directly relating to securing a development contract, such as legal fee, feasibility reports, marketing research, engineering surveys, they are also included as part of the development contract cost, project cost, and if they can be separately identified and measured reliably, and it is virtually certain that the contract will be secured, then only you would recognize them. Otherwise, you would charge them to the profit and loss. Development contract progress billing account is also created. This would be the receivables from the customer, and you will produce a progressive billing mechanism, which would be a liability or a corresponding liability whenever you send a bill. And this would be recorded as development contract progress billing. Sometimes you get a mobilization advance, which is given by the customer. Subsequent measurement would be the development contract project cost at end of the period. It shall be carried at the cumulative cost, because this is an account which is increasing every day. All costs are parked in this account. And you will check it for impairment, and impairment is according to FAS 30. If there is an allowance of impairment according to FAS 30, then you would record this from the development contract project cost. A delay in or inability of the customer to make contractually agreed progress payments against the development contract shall be considered as an objective evidence of impairment. So if the customer is not making payments on time, this actually is a trigger to make an assessment of impairment. Development project contract project costs subsequently measured shall include the cumulative amount of periodically recognized development contract profit. So we would recognize profit on stage of completion basis and add it to the development contract cost count. Any receivables from the customers, net of recoveries and adjustments, shall be subsequently measured at carrying value less expected credit loss. Now, this is a receivable which is payable in cash. So it would be exposed to the expected credit loss regime according to FAS 30. In case receivables from the customers after completion of development contract and delivery of the subject matter involving a deferred payment, an unamortized amount of deferred profit shall be shown as a deduction from the gross amount of the receivable. So if this Istisna contract also includes a deferred payment sale add-on, then you would show the unamortized amount of the deferred profit as a deduction from your total profits. We have discussed the allowance of the allowances, the expected credit loss and impairment. They would be treated as such. Subsequent measurement of the development contract progress billing account at the end of each financial reporting period shall be reported as the end of the financial period. The net liability shall be shown as a development contract progress billing account, and the net asset shall be shown as the development contract progress at the net value. Sister Sarah, is there any question till now?
There was a question, basically, anonymous attendee has asked, it is not clear on the scope of the ED on Istisna as stated in paragraph of the ED. Does the standard is meant to be applied by the property developer or an IFI?
So this needs to be used by the IFI, not by the property developer. So the Islamic financial institution is developing on behalf of a customer. Now, you may not be developing yourself, you may be subcontracting it to somebody else, but you are the same.
Same person has another query. The term used in the ED is Istisna-based contract. Why is that so? Why not using Istisna contract? Please explain the difference between the two, if any.
Okay, so we discussed it earlier at the start that the deferred delivery sale contracts, they include both Istisna and Salam contracts. So the discussion was that they share a lot of common elements. So the deferred delivery sale standard, which we discussed earlier, it includes Salam and Istisna. Now this development contract ED is only for those Istisna-based development contracts, which which exhibit the characteristics shown in paragraph 5, the definition of the development. So this is only for those long-term Istisna contracts which are of development nature. But short-term Istisna contracts would actually be covered by the first ED. Right. So if there is no other question, we'll move to
There
the
are no
next
other
slide.
questions. Do you want to take a break for prayers at this stage or later?
I think it would be finished off in maybe 20 minutes. So let's complete this and then take a break at the end. Right? Because we don't have too much to move.
Okay, okay.
Right. So development contract revenue, accrued revenue against development contract is to be recorded as a receivable against the development contract progress. And there is a rebuttable presumption that in all Istisna-based development contracts, the revenue may always be reliably measured as Istisna is generally a fixed price contract. However, in certain circumstances where variation in revenue are expected due to variations in delivery date, extra work, or change in specifications, the prudent estimate of the revenue shall be applied for the purpose of application of stage of completion method. So because it is a fixed price contract usually, the concept is that you may identify the stage of completion. So you can easily identify what stage are you on, and the accrued receivables can be recorded as receivables. In case of a mutually agreed change in development contract price, the total expected revenue, any such change shall be incorporated in the total amount of expected revenue as and when contractually agreed. So if there is a change by both parties in the price of the contract, which is usually not there, but in some cases it may happen, then your revenue would change, and this would be incorporated on the date on which it is contractually agreed, and then we will start including it. In Salam, this has to be done at the end of the contract when the sale happens, but in Istisna, it would be on the date on which the contract is changed because of price. In case of such transactions where full or part of the price is to be received on a deferred basis after the delivery of the subject matter, the revenue referred to in paragraph 1821 for the purpose of application of stage of completion method shall exclude an appropriate proportion of the revenue which shall be deferred and recognized over a period of time in line with requirements of respective financial accounting standard, that is Muraba and other deferred payment sales. So this actually talks about the situation where after the Istisna development, the sale is done through a Murabaha contract, then the requirements of Murabaha would be applicable on the second leg of this transaction. An appropriate amount of revenue to be deferred in line with the requirements of paragraph 22 shall be equal to the difference between total sale price of the subject matter and the estimate equivalent cash sale price that would have been paid in case a full settlement of the same had taken place at the time of delivery of the subject matter. So in case the payment is on deferred delivery, you would find out an estimate of the price between the total sale price and the equivalent cash sale price, because you are paying it on a deferred date. This difference is because you are not paying the full price right now, and this would be amortized over the development contract. Cost of revenue at the end of each financial reporting period shall be recognized on a stage of completion basis. So we would recognize revenue based on the stage of completion that have been complete, based on the cost and the selling price corresponding to the development contract revenue. The development contract cost of revenue may include an additional cost element in case of wondrous situations, because wondrous situation loss that would happen in future needs to be included in the cost, and because of this, the stage of completion would change, and this effect would be possible if there is a wondrous contract. Now, the subsequent measurement of the stage of completion method. Under the stage of completion method, development contract revenue is recognized in the statement of income of the relevant financial reporting period in proportion to the stage of completion of the subject matter. So if you have completed 60% of the work, then you would record 60% of the revenue and 60% of the project cost as an expense. And of course, 60% of the profit would be the. If there is an onerous loss, whereby it is expected that the total development contract project would exceed the total development revenue, it shall be immediately recognized irrespective of stage of completion of the development contract. So if you find out that the total cost of the development is more than the revenue, then this amount should be recorded as onerous loss and included irrespective of whatever stage you are in. A change in estimate with regard to total development contract revenue and the total development contract project cost that results in an increase or reversal of a previously recognized onerous loss shall be immediately recognized in the statement of income in case such change in estimate results in a situation whereby the revised total development contract revenue in case of contract renegotiation exceed the revised estimate of the total development contract project, profit recognition on the basis of stage of completion shall be resumed. So if there is a situation where the total development contract revenue and the total development contract project costs, because of the recognition of onerous loss, it is not possible to find out the correct percentage. Then in that case, you would find out estimated change and then revise the total development contract revenue and record it based on that new value. Derecognition would be at the time of the conclusion of the contract and completion of and handover delivery of the subject matter to the customer. The development contract project cost and the development contract progress billing, both accounts would be derecognized. Any difference in these accounts would be recorded in the statement of income. It could be gain or a loss. In most of the circumstances, both accounts shall have equal value, so they would net off. But in certain situations, there could be a difference in value. this value would come in because of the impairment loss that we have recognized. Otherwise, they would always be the balanced items. So they would set off each other. Now, if you are not able to assess the stage of completion, this would be an unusual circumstance. And the total expected development contract project costs are not measurable reliably. Then you need to cease to follow the accounting prescribed by this standard and follow the requirements of AOF financial accounting standard, which is applicable on deferred delivery sales, if such limitation is identified during the first financial reporting. So you would cease to follow this standard and start following the deferred delivery sales standard, which we covered earlier. And you also cease to recognize any development contract revenue and reverse any revenue that you have already recognized in the excess of already recognized development contract cost, if such limitation is identified subsequent to the preceding financial reporting period. So any revenue which is in excess of the cost needs to be reversed back, because now you are following the deferred delivery sale. In case you are unable to assess the stage of completion and you have reversed the revenue, once a reasonable estimate of both the stage of completion and the total expected development contract costs can be made, the remaining development contract revenue and profit shall be recognized on a stage of completion basis, including any cumulative effect of the same as of that date. So afterwards, if you are able to once again assess the stage of completion, then you would start following this standard again and follow the stage of completion method and recognize revenue and costs. Onerous Istisna-based development contracts shall be dealt with in line with AOF FAS on impairment, credit loss, and onerous commitments, that is Financial Accounting Standard 30. Then we come to the presentation and disclosure part, which is the general presentations, apart from which are given in Financial Accounting Standard 1. You need to give the minimum disclosures like accounting policies, the project cost at the end of the financial reporting period, the liability for development contract progress billing and the receivables from the customers, the development contract revenue, the development contract project costs of revenue, and the profit which is coming out of this project. If there is an unamortized deferred profit, then you need to show the movement of this for the year. And if there is an allowance for impairment, then you need to disclose this allowance for impairment. The balance of the Istisna development project in progress and outstanding progress billings, they need to be presented on the appropriate side of the statement of financial position without netting off. So these would be two different accounts which are on the debit and credit side, and where the contract includes a parallel element, then this would be separately disclosed because it's a separate contract from the original Istisna. So now we are done with the Istisna-based development contract in the books of the seller. We would now start with the buyer, but before this, are there any questions?
There is one more question by the same person. Thank you for the clarification on the scope. If you may share, is there a current example of financial reporting from any publicly available annual report of Islamic banks where the Islamic bank is constructing or developing an asset property on behalf of the customer? I would like to read the IFI annual report to further understand the current financial reporting practice and the applicability of this ED to an IFA in general? Thank you.
Thank you for the question. On top of my head, I don't have a name, but Islamic Development Bank, ISDB, has these projects. So, but I'm not sure that they give this detail, because this is a standard, because their products are completely different from a normal system. They are basically giving this to the governments. So there are certain sovereign limitations applicable. We will look into this, and if there is an example, we will come back. Right, sister. So should we move to the next part?
Brother Arsalan has raised his hand.
Brother Salan, please.
Yes, I have actually two comments on this
Right.
standard. One is again the same one which we discussed in the previous, related to scope of the standard.
Yes.
I
Yes.
hope you will. Okay. The second is what I understood from this standard is that revenue shall be recognized in accordance with the stages of completion, right?
Right.
However, practically what happens under Istisna, banks disburse funds in accordance with stages of completion. But from Sharia perspective, they don't conclude the contract. Completion is done, accordingly disbursement is made, but delivery does not happen, right?
Yes.
So
Yes.
how that practical that actual situation will be catered to under this standard? Shall
So,
we wait for conclusion of istisna,
no,
or
no,
stages
brother.
of completion is already there?
No, brother. Now this concept of performance milestones have been included here. So if you see the slides, uh, there are performance milestones. Once you attain the milestone, you can recognize the revenue. So the contracts needs to be incorporating the milestones. This is a change since IFRS 15 came up. This is a change in conventional accounting contracts also. And the same would happen here.
So
Right?
okay,
So maybe, a milestone could be that you have constructed the first floor. That is one milestone. The second floor could be the second milestone. You can actually build milestone in different contracts.
okay, thank you. But the point here is, istisna will not be concluded. Okay, there are
No.
performance milestones,
Yes.
but from the the concept which is the transfer of control, which is the basic requirement. So the property
Yes.
is still under construction. It's not delivered under istisna, risk and everything of the property is with the customer. On the other side, I did not get control, but I'm still recognizing the revenue. So
Revenue.
isn't this contradicting with the fundamental principle?
No, brother, you are making an effort, or you are constructing, and you are recording revenue in your financial statements. Being a
So
bank, you have the asset on your books which you are constructing for the customer, and based on the milestones, you are recognizing revenue.
this is my point. Okay,
Yes.
I have completed the asset, certain milestones, but
Yes.
still control is not transferred, right?
Control is
So
not transferred.
control or risk is with me.
Yes, that's why the asset is on your books. Because if you transfer the control also, then the asset would go out of your books,
Yes.
right? So, brother, till we are constructing the asset or manufacturing it, in case of plant and machinery, it will remain in our books. The work in process would increase the development account, and we would recognize revenue based on the milestones, the stage of completion. And once it is complete, we will hand it over, and then we would de-recognize it, and it will go in the customer's books.
So just for understanding, thank you very much. So
Yes.
can we say that this treatment is actually a bit of deviation from the fundamental principles, where we normally ask, for example, in the Salam, we said revenue shall only be recognized when control of the inventory is transferred to other party. In this case, control is with the bank. Bank is constructing, but still
Yes.
bank is recognizing at the same time revenue. So
Yes.
it's a bit of
So-
deviation from the
So
that
whether
principle.
that is actually a Sharia debate, and I don't want to get into that because I'm not a Sharia expert, right?
No,
Yes,
accounting, it's from
yes, this
accounting
is
perspective, boss.
from accounting perspective, yes, because we have introduced the concept of performance milestones. We can actually recognize revenue. And this is aligned with IFRS also. If you look into IFRS 15, it also talks about performance milestones,
Okay, perfect.
right?
Fair
Right.
enough.
Thank you. So let's move to the next part, which is Istisna-based development contracts in the books of the customer, the buyer. The buyer has given advance. So advance cash payments paid by the customer to the developer in the form of mobilization, advance, or progress billing shall be recognized as and when the advance payment is made in lump sum or in installments, if any, in line with the contractual arrangements as advance against Istisna-based development project, equivalent to the amount of cash paid. So the buyer would make a payment to the bank in advance and record it as Istisna-based development project, advance against Istisna-based development project. He would not record it as a receivable because he would be getting this Istisna-based development project in return. So this would be advance against Istisna-based development. This advance at the end of each financial period shall be reported at its carrying value less any transfers to the Istisna-based development project in progress account, less allowance for expected credit losses. So there could be a situation where there may be a credit loss. So you need to record this according to Financial Accounting Standard 30, impairment, credit losses, and progress. A delay in or inability of the developer to perform delivery of the subject matter is evidence of impairment, and you need to make an assessment for the impairment because of this delay. Now, Istisna-based development project in progress at end of each financial reporting period shall be recognized to the extent of the project stage of completion as of that date. So this is the work in progress account, which is based on the project stage of completion. Through transfer from advance against Istisna-based development project, or by way of recognizing a liability, which is payable to the developer, in case such estimate is in excess of the advance already paid. Explanation is also given here to just clarify. A liability to be recorded in this respect shall not be confused with any progress billing from the developer, unless the same is strictly corresponding to the stage of completion of the Istisna-based development project. Any such progress billing in the excess of stage of completion may constitute a firm commitment, but not a liability. So any progress billing is not coming in the Istisna-based development project in progress account. They are separate. They need to be separately identified, and this account is completely distinct from the. Now, this account shall be subject to impairment testing at the end of the financial reporting period. And if there is any impairment, it would be according to Financial Accounting Standard 30. We have done it earlier also. Now, once the subject matter is complete and it is delivered from the developer to the customer, the time when the customer requires the complete control, the risk and rewards incidental to the ownership, that is the time on which the buyer would acquire the subject. A delivery of the subject matter not matching the contractual specifications may trigger a need for reassessment of impair. If the delivery is not according to specifications, then you may need to make another assessment of impairment based on this. Presentation and disclosure, you have to follow Financial Accounting Standard 1, general presentations, and also provide accounting policies for the development transactions. How would you recognize advance against Istisna-based development projects, Istisna-based development projects in progress, etc.? Disclose the advances if it is in full or in part to the developer. What is the stage of completion of the subject matter and any movement in that, and if there is any impairment, you need to disclose this impairment. You need to also disclose the total progress billing to date, which is due for payment. It should be gross and net both amounts, adjusted for payments made against the progress billing to date or adjusted against advance payments. And you should need to show the movement also. And if there is any commitment for making any payments, you need to show that also falling within the next 12 months or after the 12 months period. So it should be classified into 2 months. You need to also disclose sale of subject matter according to the sale based under agency or as direct sale. How will you be selling that? Amounts receivable against the sale, bifurcating between receivable from the eventual buyer and the agent, revenue and profit recognized, if there is an expected credit loss, and if there is an unrisk commitment, you need to classify them accordingly. And if there is any amount of amount written off or waived with the nature of this transaction, you need to disclose this also. The balance of the Istisna-based development project in progress and outstanding progress billings shall be presented on the appropriate side of the statement of financial positions. You will not net it off. They would be shown separately. And if there is a parallel element, then this would be separately identified. This is a completely different concept. So we have discussed parallel Istisna. So I'll just skip this slide because that is a separate accounting, separate contract. We have also discussed the onerous part. Subsequent change in price or cost. In Istisna, there could be a change in price or cost. So if there is any subsequent change, it shall be accounted for when it becomes virtually certain. When you are certain that this price would be there, then you need to record this. Any change in the eventual profit or loss shall be adjusted according to the changes in estimates in respective computations according to the stage of completion. Because the revenue or the cost is changed, the price or cost is changed. That's why the stage of completion method and the revenue would also change. And this change would be recomputed based on the change in progress. This standard is also planned to be adopted on or after 1st January 2027, and early adoption is encouraged. So this covers the second standard, the Istisna-based development standard. So now the floor is open for any questions. If you have any questions, this is the time to ask. Sister Sarah, are there any questions?
No, there are no more questions.
No more questions. So I think this is concluded from my side.
There's no question? Okay, there is one question from Deep Amar Khalid,
Right. Please,
but he didn't write it.
can you share this question?
He just write, I have a question.
Okay. Brother Deek, can you write the question? Or if you may allow Brother Deek to open his mic.
The question is istisna available to contract by the seller or buyer?
So, brother, it could be both because we have istisna and we have parallel istisna. So, yes, it could be both sides, the seller or the buyer, and they are independent of each other. So, just to explain, on one contract, the bank may be the developer, and the customer would be there to buy it. And in a parallel istisna, the customer would then sell it to someone else. So yes, this would be possible. Right. So thank you very much, Sister Sarah. Would you close this session?
Thank you, Brother Harun, for the insightful presentation and the Q&A question and answer session. We'd like to thank again Dubai Islamic Bank, all participants, and all our colleagues here in IOFI. See you, inshallah, in next future events. مع السلامة.